At $100 a month, the first 10 years feel almost painfully slow. But by year 40, your own contributions could represent less than 10% of your final portfolio. That is where the math becomes almost difficult to believe. And that is exactly what I want to show you today. Because the simplest way to build serious wealth doesn't require a business idea, a lucky break, or wealthy parents. It just requires starting and staying consistent. I've spent the last few years helping people who thought they weren't the type to invest realize that they absolutely are. So let me show you how $100 a month can become the foundation for real, lasting wealth. Let me take you back a bit first. When I started working in finance, you'd think I had my money sorted. I didn't. I was earning a decent salary, working at a bank, surrounded by people who talked about markets all day, and I still had almost nothing saved. I'd spend hundreds on lunches I barely enjoyed. I'd buy things I didn't need. And every single month, I'd promise myself this was the month I'd finally get serious about saving. Then payday came. I'd check my account. And there was almost nothing left. All those hours, all that work, and I had basically nothing to show for it. Sound familiar? The thing that actually changed everything for me wasn't a book or a podcast. It was watching a colleague get made redundant. One day she was sitting right next to me. The next, she was gone. No real warning. And I remember sitting there afterwards thinking, that could be me. I had been treating my salary like it was guaranteed, like it would always just be there. And in that moment, I realized it absolutely wasn't. Everything I'd built my routine around could disappear overnight. So I wanted more control. I wanted independence. And I decided to actually do something about it. I started with the most unglamorous thing you can imagine. An emergency fund. Not investing, not stocks. Just a savings buffer. I aimed for 1 month of living expenses first. Nothing huge. But once I hit that, something shifted. It felt good, so I kept going. 1 month became 3. 3 became 6. The standard guidance is to hold around 3 to 6 months of essential expenses in an accessible account, and there's a good reason for that. Because I knew I wanted to start investing, but I also knew that if something went wrong, a job loss, a big unexpected bill, and I had no cushion, I'd be forced to pull money straight back out of my investments just to pay the bills. An emergency fund doesn't remove investment risk, but it reduces the chance that you'll be forced to sell during a market downturn, and that matters more than most people realize. So if you haven't got one yet, that is step 1. Then I started investing, and working in finance did give me a head start. I understood how markets moved, but the thing that genuinely surprised me was how little you actually have to do once you start. You don't need to be glued to a screen. You don't need to analyze charts or follow the news every morning. You just put a set amount in every single month, leave it completely alone, and let the maths work for you. That is the whole secret. It is pure maths. And right now, you're probably thinking, okay, but I've probably missed the boat. Maybe you think investing is only for people with loads of money, or that you should wait until inflation settles, or the economy looks more stable. I hear this all the time, so let me show you exactly why waiting for the perfect moment can often cost you more than starting gradually. Let's say you invest just $100 at the start of every month into a simple, diversified, low-cost index fund, the kind that tracks a broad basket of companies rather than putting everything in one place. For illustration, we'll use a 10% historical nominal return based on the long-run average of the S&P 500. That is not a forecast. Markets don't move in a straight line. Your actual returns could be significantly lower, and you'll want to factor in fees and tax depending on how you invest. But as a working illustration, here is what the maths looks like. After 2 years, you'll have put in $2,400 of your own money, and you'll have around $2,666 in your portfolio, about $266 of growth. Not thrilling, I know. And the reason it doesn't feel like much is because at this stage, you were doing almost all of the heavy lifting yourself. Nearly everything in that account is your own money. There might even be moments where you have less in there than you put in. That is completely normal. That is just how it works early on. And it is the reason most people give up. They look at their portfolio, see barely any growth, and think it isn't working. But stopping here is the worst thing you can do, because the good part is coming. You just have to stick around for it. So let's look at 10 years. Same $100 a month. After 10 years, you'll have contributed $12,000 of your own money. But your portfolio, with that same projected return, could be worth around $20,655. That's over $8,600 in growth. Money that came from keeping your money invested and allowing returns to compound over time. And if you keep going, 30 years with that same $100 a month, you could be looking at $227,932. And after 40 years, over $637,000 from $100 a month. Now, I want to be honest about 2 things here. First, $637,000 in 40 years is not the same as $637,000 today. With an average inflation rate of around 2.5%, that figure would be worth closer to $237,000 in today's purchasing power. That does not make the strategy wrong. It makes increasing your contributions over time essential. Second, $100 a month alone does not make you a millionaire. What it does is build the foundation that eventually can. And here's what that looks like when you scale up. Let's say in your 20s you invest $100 a month. Then in your 30s, if your income rises and you're able to increase that to $300 a month, you'd enter your 40s with over $117,000 already built, made of around $56,000 of your own contributions and over $61,000 in compounded growth. Then in your 40s, if you invest $600 a month, that grows to over $443,000. And if you invest $800 a month in the final decade before retirement, your total portfolio could exceed $1.3 million. Over the full 40 years, you'll have personally invested just over $216,000. Your portfolio, over $1 million. That is compound growth. Your investment returns begin compounding on top of previous returns. And it does not require genius or a huge salary. It requires consistency and time. Now a good time to invest? This is the question I get asked more than almost any other. And right now, there's no shortage of things to worry about. Inflation, interest rates, global uncertainty, talk of recessions. So it feels completely logical to think, I'll wait until things calm down. The problem is, people have been saying this forever. In 2008, people thought the financial system was collapsing. At the start of COVID, millions panic sold their investments, convinced markets wouldn't recover for years. And through every crisis, every headline, every piece of bad news, the long-term direction of global markets has historically been upward. That does not mean there aren't dips. There are. Sometimes significant ones. Your portfolio will drop at some point. That is part of this. But zoomed out over 10, 20, 30 years, the overall trend has historically been up. This is why you'll hear the phrase, time in the market beats timing the market. Because by the time things feel safe again, markets have usually already recovered. Meaning the people who waited end up buying at higher prices than the people who started during the uncertainty. The third thing that stops people is the belief that investing is just too complicated. And honestly, I completely understand why. Search how to invest on YouTube or TikTok, and you'll find thousands of videos promising to help, and most will leave you more confused than when you started. Someone says, buy individual stocks. Someone else says, crypto. Another person says, wait for the crash. You end up going down a rabbit hole and still not actually doing anything? This is not because you're lazy or bad with money. A 2026 survey commissioned by Nest found that 37% of Americans still believe investing is reserved for the super rich. That is simply not true. But it is why so many people stall. For many beginners, a diversified, low-cost index fund is a simple starting point, provided the money can remain invested for the long term. You don't need to become an economist. You don't need to understand every market movement. The hard part isn't the mechanics of investing. It's overcoming the mental blocks we've been talking about today. What account should you open? What should you actually invest in? How do you avoid the expensive mistakes beginners make? Those are the questions I'll be covering in the next videos on this channel. So if you want to keep going, subscribe, and you won't miss them. But whether you join or not, the message I want you to take from this video is simple. You don't need a lot of money to start. You don't need a high income to get started. You don't need to be smart, lucky, or already wealthy. $100 a month probably won't make you a millionaire on its own, but it can build the foundation that eventually does. In future, you will probably be very glad that you started.